Netflix reports earnings today. The stock is up 10% this year already. They just raised subscription prices for the second time in a year. And then recently they walked away from an $83 billion acquisition of Warner Brothers and got paid $2.8 billion just to walk away from that. Moreover, they have 325 million subscribers and are continually growing. By the end of this video, you're going to understand what Netflix is becoming, why that's a great long-term investment, what today's earnings mean, and 3 numbers I'm personally watching, and whether at current prices it's still worth holding. What's happening right now? As I mentioned, Netflix reports its quarterly results today. Every 3 months, public companies have a requirement to tell the world exactly how much money they've made, revenue, profit, everything, and today is exactly that moment for Netflix. Here's what the experts are expecting. Revenue of $12.17 billion. That's the total money coming in from advertising, and that is up approximately 15.5% from the last year. A year ago, they made $10.54 billion in the same period. Now it's already nearly $2 billion more just by doing what they already do. Earnings per share. Let me explain what this is because it's one of the most important numbers in investing and most people gloss over it. Netflix has roughly 430 million shares in existence. Every single one of those shares represents a stake of ownership in Netflix. When Netflix makes a profit, that is after covering all of their costs, that profit gets divided by the total number of shares, and the result is the earnings per share. So if Netflix makes 330 million in profit and there are 430 million shares, then each share earned roughly 77 cents of profit. That's the number we're looking at here. And why does that matter? Because it tells you exactly how much the business is earning for each piece of ownership you hold. If the number goes up year after year, then the business is becoming more valuable. If it goes down, something's wrong. 1 year ago, earnings per share were 66 cents. Today, they're expecting 77 cents. That's a 16% increase in profit per share in just 12 months. As an investor, you didn't have to do anything. You just held the shares and you generated 16% more profit in 12 months. This is the compounding effect in action. Not spectacular in a single quarter, but compounded over 10 years, the value of what you own multiplies significantly. And that's really the long-term investor's gain. Operating margin is expected at 32.1%, meaning for every dollar Netflix brings in, they keep 32 cents as operating profit after covering their costs. And that number is growing because the business is becoming more efficient as it scales. Good news for investors. So one thing worth knowing before we go any further. Netflix did a 10-for-1 stock split in November 2025. The simple explanation is that if you owned 1 share worth $1,000, you now own 10 shares worth $100 each. Total value identical. Companies just do this to make their stock more accessible to smaller investors. So when you see EPS of 77 cents, pre-split that would have been $7.10. Same number, it just looks a little bit different. Don't let that confuse you. The stock is up about 10% this year and is currently sitting near $102. Here's an interesting signal. The options market is pricing in a 6.54% move in either direction after today's news. That means traders are expecting a meaningful move either way. This is not going to be a quiet day for Netflix investors. And finally, 30 out of 40 Wall Street analysts who cover Netflix full-time have assigned it a buy rating. Their average price target is around $115. From the current price of $102, that's an estimated 13% upside, if they're right. And as always, analysts aren't always right, but when 30 out of 40 professionals who study the same company for a living all say the same thing, it's worth taking notice. The Warner Brothers story and why it matters. In December 2025, Netflix announced it was trying to buy Warner Brothers in a deal valued at $83 billion. It would have made Netflix the most powerful media company on earth overnight. Then Paramount Skydance came in with a bigger offer, $111 billion. Warner Brothers, of course, said that was a far superior deal. Netflix had 4 days to match that offer. They looked at the numbers and decided that taking on a higher offer would require taking on around $40 billion of debt. And so they walked away. And walking away earned them $2.8 billion. This was a breakup fee paid by Paramount. Netflix stock went up 17% after walking away from that deal. So the market cheered for Netflix for not going into that new deal. And why does that matter for long-term investors? Because it tells you exactly what kind of company Netflix is. Disciplined. They wanted HBO and the Warner library, but not at any price. And that kind of restraint in corporate America is rare. It's a green flag. A CEO who says no to a big deal even when their ego says yes. And now that $2.8 billion for exiting the deal flows back into Netflix. Share buybacks, which were paused during the acquisition process, are back on the table. That's $8 billion in buyback authorization still available. Buybacks reduce the number of shares outstanding, which increases the value of every remaining share you hold. What Netflix is actually becoming. Most people think of Netflix as a streaming service. You pay $15 a month, you watch shows and movies, that's it. But that's not what Netflix is anymore. Netflix is becoming three unique businesses simultaneously. First, the subscription business everyone knows. 325 million members paid globally. Second, an advertising platform. Advertising revenue more than doubled to $1.5 billion in 2025, and they're targeting $3 billion this year. Third, live sports and events. They just added 4 NFL games, including Christmas Day and Thanksgiving. They have boxing, they have Formula One. Live content keeps people subscribed and drives advertising revenue. And live content is a massive future projected industry. This transformation is the thing that most investors are missing when they look at Netflix. It's building a full media empire. Original content, live sports, advertising, all in one platform. Now, the price increase question. They raised it twice in the last year. So why aren't people just canceling and leaving that platform? Well, actually, the data says no. When Netflix raised prices in January 2025, they added 23 million new subscribers across that year. People complained, some canceled, but far more new people joined. The product is sticky enough that any pricing changes don't matter that much. And one analyst estimates that the price increase alone increased revenues of $1.5 billion. History and philosophy. Netflix has reinvented itself 3 times. A DVD rental company in 1997. A streaming service in 2007. They saw the internet coming and pivoted before Blockbuster even understood the threat. Original content creator in 2013. House of Cards, the show, was the moment they stopped just licensing other people's content and decided to start making their own. Now they have advertising and live sports. Each reinvention looked uncertain and expensive at the time. Blockbuster laughed at the streaming pivot. Wall Street was nervous about the content spend. Both times Netflix was right and the doubters were wrong. This is the innovator's dilemma. Clayton Christensen's framework. Established companies fail not because they're bad at their current businesses, but because they protect it too carefully and miss the next thing. Netflix has consistently done the opposite. They disrupt themselves before someone else does. That's extremely rare and extremely valuable. Sun Tzu said, in the midst of chaos, there is also opportunity. The streaming wars of the last 5 years, Disney, HBO, Apple, Amazon, all throwing billions of dollars at content, looked like chaos. But Netflix survived it, strengthened it, and now is expanding its strong position into advertising and live sports, while others are still fighting that last battle. The Warren Buffett moat test of this business. Does Netflix have something that is genuinely hard to replace? Yes, they do. 325 million subscribers and growing, a content library worth billions, brand recognition in almost every country on earth, and now an advertising platform being built from scratch on top of the world's most watched streaming service. That's a very wide and deep moat. So the 3 numbers I'm watching today. Number 1, advertising revenue. This, I think, is the single most important number in today's report. Netflix needs advertising revenue to double to $3 billion this year. Today's report will be the first signal to determine if they're on the right track. If ad revenue is growing faster than expected, that's a very bullish sign. If it's weak, the stock likely drops, because ultimately advertising revenue is the new growth engine, and the market will price it aggressively in either direction. Number 2, subscriber numbers and any guidance. Netflix stopped reporting detailed subscriber numbers recently. They only give total paid memberships occasionally now, but any commentary on subscriber growth, despite the price increase, is crucial. 325 million is where they ended in 2025. Any signal of continued growth at that pace, despite higher prices, confirms the pricing power thesis. Number 3, what they say about the $2.8 billion and buybacks. Management commentary on how they deploy the Warner Brothers $2.8 billion breakup fee is a third thing to listen for. If they signal aggressive buybacks, that's shareholder-friendly and bullish. If they signal they're hunting for another acquisition, that would be a more cautious reaction. Should you buy, hold, or wait? Personally, I invest in Netflix. I'm going to keep dollar cost averaging, and here's my honest reasoning. The valuation is not cheap. PE ratio of 42 means you're paying a premium, but revenue is growing 15% a year. Operating margins are expanding. They now have 3 revenue streams instead of 1, and they just demonstrated great leadership and discipline by walking away from from a bad acquisition. Premium businesses with pricing power and expanding margins deserve premium valuations. The risk worth knowing, content spend of $20 billion in 2026 is enormous. If that content doesn't drive subscriber growth and advertising revenue, then the margins compress. The operating margin guidance of 31.5% for the full year was already slightly below analyst expectations. So watch that number carefully. My approach, I'm not buying more today before earnings reports. The options market pricing in at 6.54% move means this is a moment for patience and not action. If the report disappoints and the price drops, that could be an interesting add point. If it beats and it runs, I'm already in and I benefit. Dollar cost averaging into Netflix makes sense for long-term investors who believe in the 3 revenue stream thesis, but don't chase it after a big earnings bet. Wait for the dust to settle.